Hi, I'm Suzy Rhodes with Past Masters. Welcome to this week's Questions of the Week. This week, our topic is Characteristics of Equity Securities. You can expect this topic to appear on the SIE exam, Series 6, Series 7, and Series 65. We will be doing a 10-question topic quiz from within one of our Past Masters Securities courses. Let's check out our learning management system. In a regular way transaction, the latest an investor can place a trade and still receive the dividend is the... What? That's a lot. I have to write this down. I learn by writing. So let's check out what in the heck is happening here. So equities can pay dividends up to quarterly. Dividends are paid at the discretion of the board of directors. So the board of directors meets quarterly and decides if they're going to pay a dividend. So I'll make up a story. Let's say that 4/7, the board of directors declares a dividend. So we have what is called the declaration date. So let's say they decide that they're going to pay $1 dividend per share. And we're talking about here common stock. The board of directors sets the declaration date. The board of directors also sets what's called the record date. So the record date is the day that your name must appear on the books and records of the issuer in order to receive the dividend. The board of directors for common stock is also going to set the payable date. So the board sets these 3 dates when we're talking about common stock. Declaration is going to be first, record date is second, payable date is third. But like this question asked, when is the latest you can place a trade and receive the dividend? So we know that your name has to be on the books and records as of the record date, but there's a FINRA rule that's going to come into play here. So we have FINRA's rule, which is called regular way settlement, which says when do you have to pay for a trade? So trade date plus 2 business days. FINRA's regular way settlement, T plus 2. So T stands for trade date. This rule goes together with what is called the ex-dividend date. So if you have an ex-spouse, are you with or without them? Gratefully without them, right? So a stock that is ex-dividend is a stock that's trading without the dividend attached. So we're going to make up some things here. So we're going to say that the 20th is a Friday. I don't have a calendar. We're going to go back in time to the 19th, which is Thursday, to Wednesday, which is the 18th. And let me just make up a story here. So if you had placed your trade on Thursday, just as a exercise here, placed your trade on Thursday under regular way settlement, when would you have to pay? T plus 1, 2. Friday, Saturday. No, we don't pay on Saturday. Friday, Monday. Would you have made it to the record date by the 20th? No, you would have just missed it. So when you have common stock in a regular way transaction, it is going to go ex-dividend on the business day prior to the record date. So the X date, that could be very well a question on a securities exam. So what's the latest you can place the trade? So if we place the trade on Wednesday, if this was the trade date, we'd have to pay under regular way 1, 2. Would we make it to the record by the record date? Yes. So you have to place the trade under regular way by the business day prior to the ex-dividend date. Unless it's settling in cash settles same day, in which case you could have placed the trade on Friday. So let's go back to the question. The latest the investor can place a trade and still receive the dividend. Choices include payable date, record date, day prior to the ex-dividend date, or ex-dividend date. We know it is the day prior to the ex-dividend date. It said right in the question, under a regular way transaction. So within our learning management system, you choose what you believe is the correct answer, click check answer. We find out we got it right because we got a green check mark. Click show explanation to see the full written out explanation. You can also click on an audio explanation for every one of our questions.
In a regular way transaction.
It's me. So be sure if that is helpful to you that you listen to the explanations. Which type of equity security has a fixed dividend rate? So stocks may pay dividends up to quarterly. Let's see our choices. Priority, preferred, common, or classic. Priority and classic are just made up to trick you. There's two types of equity that can be issued by a corporation, common stock and preferred. Preferred stock is the one that has a fixed dividend rate. So let's say that it's a 4% preferred stock. Par value on preferred stock is $100. 4% would be the annual dividend. It does not guarantee that a dividend will be paid, but if it's a 4% preferred stock, you know that the dividend, if it is paid, would be $1 a quarter. So 4% of par divided by 4, $4 divided by 4. That's where the dollar came from. Preferred stock has a fixed dividend rate. Company LMN declares a stock dividend of 20%. Nikki owns 1,000 shares of Company LMN stock at $20 a share. Which of the following accurately reflects Nikki's position after the dividend has been distributed? So choices include, just looking at them real quickly here, 800 shares, 1,000 shares, 1,200 shares, 1,200 shares. So a stock dividend, is Nikki going to have more or less than 1,000 shares? She's going to have more. How much more? 20% more. Well, both of the choices that were more than 1,000 were both 1,200. So we can get rid of 800 shares. We can get rid of 1,000 shares. So we know that the choice is either 1,200 shares at $20 a share or 1,200 shares at $16.67. Something really important when we talk about a stock dividend. The amount of money that Nikki has invested in this position does not change. So it cannot remain at $20 a share. Instead, it has to be less. So we only have one choice where the share price is less. 1,200 shares at $16.67 a share. Now, you can use your basic non-programmable calculator to check on your math. So remember that we cannot create money out of thin air. This was a stock dividend. So we have 1,000 shares at $20 a share. So $20,000 total in this investment. But Nikki doesn't have 1,000 shares anymore. How many shares does she have? She has 1,200, and that gives you a share price of $16.67. Another way to check it would just be to take the $16.67 times 1,200 to get to $20,000, which you knew was the initial invested amount. And that when a stock dividend is declared, there's more shares, but there's not more dollars. So that's a really important point to remember. So use the calculator, don't just guess. By all means, use it. That's what it's there for. Don't get it wrong because you punched in the wrong numbers though. Use your brain too. Which of the following is incorrect about common stock? They have little inflationary risk. That is correct. They have systematic risk. Well, they trade in the market. Market risk is systematic, so that would be correct. They are last in priority in the event of a corporate liquidation. That is correct. Common stock is a residual claim on assets. In the event that the company goes broke, they get paid last. They have guaranteed dividends. No. So that is an incorrect statement. No stock, not even preferred, has guaranteed dividends. An investor owns 1,000 shares of Company A's stock. The current market price of Company A's stock is $20. Company A pays a 10% stock dividend, which appropriately describes the position of the investor now. So 1,000 shares plus an additional 100 shares is 1,100 shares. So you can get rid of the two choices that say 1,200. Now, is the price per share the same as it was originally? No, it can't be, because there's 100 more shares than before. So there's two choices, 1,100 shares at $20 or 1,100 shares at $18.18. It has to be a lower share price. You can also double check by taking the 1,000 shares times $20. So $20,000 divided by 1,100 shares gives you a share price of $18.18. Rights offerings. An issuer who sold shares of common stock and wants to sell more shares of common stock oftentimes will make a rights offering to the existing common stock holders because they know that they're the ones that are most likely to buy additional shares. So a right is a short-term option. It is good for 30 days. So if you don't exercise your right, it will expire worthless after 30 days. In general, a person holding more than blank of an issuer's outstanding shares is considered a control person. A person holding more than 10% of an issuer's outstanding shares is considered a control person. So they would be subject to Rule 144, which governs the sale of restricted stock and control stock. Dimitri owns stock in a company that has statutory voting. When voting for the board of directors, how many votes does Dimitri have? So there's two types of voting. There's statutory and there's cumulative. So in this question, we have statutory voting. The number of vacancies on the board times the number of shares he owns. However many people show up to the annual meeting, as many as there are people on the board, or the same number of shares he owns. So under statutory voting, he has the same number of shares he owns. That's how many votes that he has. Corporate directors, officers, large shareholders, and the immediate family of any of those would own which type of shares? Common stock, preferred stock, control stock, or restricted stock? It is control stock that corporate directors, officers, large shareholders, and the immediate family of any of those own. Control stock. So governed by, the sale of which is governed by Rule 144. Restricted stock are shares of stock. Most of the time they're purchased in a private placement. Restricted stock are shares of stock that are not freely saleable. They're subject to a holding period requirement. Which type of equity security may pay the stockholder omitted dividends? Common, cumulative, participating, or convertible. Convertible would be preferred stock that's convertible into shares of common. All of these special features are only found on preferred stock. Common stock is just common stock. Preferred stock may be participating, where the preferred stockholder gets to participate not only in the preferred stock dividend, but also in the common stock dividend, participating preferred stock. It's cumulative preferred stock that if the issuer omits a dividend, the current and omitted dividend must be paid to the cumulative preferred stockholder before a common stockholder may receive dividends. Common stock does not have any special features. That concludes this week's questions of the week related to characteristics of equity securities. Be sure to give this video a thumbs up, subscribe to our channel, and turn your notifications on. If you have any questions regarding this topic, just ask me in the comments below. To check out past Masters Securities course offerings or to enroll in any of our courses, there is a link found in the description to this video. Keep up the good work. I hope to have you as a student soon. Happy studies. You got this.